Welcome to Let's Finance, where clarity meets smart investing. In every episode, we break down complex financial concepts into simple, structured insights you can actually use. Let's get started. In a company that reports huge profits, yet struggles to pay its bills. How is that possible? The answer lies in the cash flow statement, the financial report that reveals the real movement of money in and out of a business. Today, we'll break it down step by step so you'll never confuse profit with cash again. The cash flow statement is one of the three core financial reports. While the balance sheet shows what a company owns and owes, and the income statement shows profit, the cash flow statement reveals the actual movement of money in and out of the business. It's the report that tells us whether a company can truly sustain itself. There are three types of cash flow. First one is operating cash flow, which means cash from daily business, the heartbeat of operations. Second one is investing cash flow, which is cash for growth, investing today for tomorrow. Third type is financing cash flow, meaning that cash from funding, loans, equity, and dividends. We've seen what is cash flow and types of cash flow statements. Remember, profit is important, but cash flow is survival. If you found this breakdown useful, hit like, share it with a friend, and subscribe to Let's Finance for more clarity and structured learning. And don't forget, following episodes dives into types of cash flow statements in detail, so stay tuned.